So this is why we get a economic cycle related very much to what's going on in the real estate market. But it's not just about the real estate market. So if we move to the next slide, it's also about
First of all, good evening to everyone. Welcome to the first ever Boom Bust Bulletin webinar hosted by Property Sharemarket Economics. My name is Darren John Wilson. I'm the editor of the Boom Bust Bulletin, also a contributor to the Property Sharemarket Economics team. Thank you for taking your time to join us tonight. I'm sure you'll learn a lot by the time the hour passes, hopefully quickly. We should be joined online by our very special guest who is in London, so it's AM for him. Akhil Patel, are you there?
Yep.
Good morning, sir. How are you?
I'm very well. Good morning to you all, or good evening, or good afternoon.
Awesome. So we haven't got much time for this one. We've got an hour, so I know people are still logging in, but we'll kick off with some housekeeping. So first things first, of course, can you please all check that you've got your mute button on to preserve our bandwidth and this staying within the time limit. We'd just like myself and Akhil to be able to speak during the conference. Great. Okay, that's good. Alrighty. The other bit of housekeeping, guys, is you'll notice down the bottom on your Zoom there is a chat function. If you click that, it will open up a box to the right-hand side of your PC screen. Feel free to put any questions that you may have for Akhil tonight. As we mentioned on the invite, we will be providing a follow-up email a few days after this, answering as many of those questions as practical. If you have anything that's more in-depth, you can always use info at propertysharemarketeconomics.com. So that's info at propertysharemarketeconomics.com. That's our inbox. If the chat function is perhaps a little bit too small for you to use, you can always use that. And then, of course, please hang around to the end because we do have for all attendees tonight a very, very special offer. It's unique to you guys. I'd really be humbled and very pleased if you guys could hang around to see that. So, without further ado, we'll just start. And before I bring Akhil in, I just thought that it would be good just to take a step back and have a look at the mid-cycle slowdown, which basically we were in when the first edition of Boom Bust Bulletin was released in October 2020. The mid-cycle slowdown can occasionally become what we call a mid-cycle recession, which is actually what we went through. Technically speaking, a recession is 2 consecutive quarters of below average growth. I think in 2020, almost every developed country went through that from the March 2020 market lows. But by the end of 2020, it was pretty obvious that the targeted and enormous stimulus that government had pumped into their respective economies had actually done the job and turned things around. And then as we turned into 2021, of course, the much mooted infrastructure plans were announced by governments as well as a way of getting economies to grow, to get people back into work, and of course to, with luck, get a return on the government money that was used to pay for it all. So in terms of where we were with the Boom Bust Bulletin to today, hopefully by the end of this, you'll get some idea of just how useful the 18.6-year real estate cycle has been for a business like Property Sharemarket Economics to demonstrate just how prescient the timing can be within the cycle. And that timing leads to the quality of forecasts that we're able to provide for our Property Share Market Economic members. And we'll be talking about all this in depth with Akhil very, very shortly. But I just thought I'd lay the groundwork. You know, the Boom Bust Bulletin community is growing every month, and we have a few extra new features that will be coming to your membership shortly, but keep an eye on your inbox soon. We'll send an email for that. But things are growing. We're obviously chosen this time as well because according to our research of the real estate cycle, the second more speculative half of that real estate cycle looks like it's already begun. So it's important that we engage with both you guys at our Boom Bust Bulletin tier membership and our full guys about what is to come. So with that in mind, I think it's time now for me to take a step back. We'll bring Akhil Patel in. And Akhil, if you'll just give me 1 second, I'll set up your slideshow. And if you can just sing out when you want the slides changed, we'll get into it. But Akhil, the floor is yours. Thank you, everyone.
Brilliant. Thank you so much, Darren. And while you load the slides, I maybe just introduce myself to those of you who haven't come across me. I know that some of you have, and I recognize a few names. But I've been studying economic and stock market cycles for about 10 to 12 years now. And I really became interested in it in the run up to and just after the global financial crisis. And largely because, and I think many of you who were investors or business owners around then would have the same question: why didn't anyone see it coming? And how could we, if this thing were to repeat, how could we be prepared better next time? And that sort of question, or those questions, were quite personal for me because my family's business went through some pretty dark times in 2009 and 2010. And a lot of the explanations that were offered for why things had gone over the top and why no one had really sort of had advance warning, I didn't think were that plausible. And part of the reason that I didn't think they were that plausible was because in the early 90s, my family's business also went through pretty difficult times. And I didn't understand why expert commentators weren't linking the two episodes, because it seemed to me that even though they looked different, they both were preceded by major run-up in property prices in Australia and the US and the UK and where I'm based. Things had gone over the top, and then we'd had a pretty significant recession, a collapse in the property market, and from the point of view of a lot of small business owners, banks were withdrawing lines of credit, which sent a number of them to the wall. And I thought, well, there's clearly something that's going on that's related, and why aren't people talking about it? So I made it my mission to investigate what that sort of parallel was, and then try and develop a body of knowledge that would help us be prepared for the next time, so that we would have advance warning, we wouldn't go through the very significantly difficult periods that a lot of us experienced in the early 2010s. And the other sort of aspect of it was, of course, in 2009, 2010, when we were going through this difficult period, it was actually absolutely the best time to be buying stocks and to be buying property and so on, and a lot of bargains to be had. And I thought to myself, well, I spent the last 2 or 3 years worrying about the future of my family's business, whereas really I should have had some money set aside to be prepared to take advantage. And I think we go through these periods of extreme regret. Is the question that we ask ourselves: I wish I'd bought then, why didn't I, sort of thing. And if you're an investor for any length of time, you'll always have that kind of story. So that's essentially why I'm here standing before you today, is the culmination of all of that. Of course, once I started looking into it, it didn't take me very long to come across the work of this Australian economist called Phil Anderson, who wrote this book, The Secret Life of Real Estate and Banking, which, if you've not heard of it or haven't read it, I really urge you to do so. And then there's sort of the work of other economists who have there's a sort of a niche fringe of people who actually seem to understand what's going on and use it successfully to forecast. And so Phil and I started collaborating informally a few years ago, and then in 2019 we joined our forces with Kathy and Darren and others to set up Property Sharemarket Economics. It's really a privilege to have you on board. As Darren mentioned, the next year, 2, 3, 4, 5 years are going to be really critical in terms of what goes on in financial markets, in the property market, not only in the UK and Australia, but globally. And so it's really an important time to be thinking, to educating yourself, trying to understand what's going on, and hopefully we can help you with all of that. So by way of an agenda, I'm going to just briefly provide an overview of the cycle. I mean, you've now probably been subscribers to the Boom Bust Bulletin for a few months, but just in case some are new, I just want us all to understand that we know what we're talking about and we're on the same page. I'll then take you through what's coming next, and then also show you some of the sort of practical ways that we can help you on the PSE side. So I predominantly do work for the main PSE subscription, but I wanted to provide a flavour of what that is, and also happy to answer any questions as to what's coming next over the next few months as I see it. So if we could go to the first slide, Darren, please. So I'm hoping this isn't too much of a new insight for you if you've been reading the bulletin for some time now. But essentially, economies move through 18-year cycles and have done so, at least in the UK and the US, the two countries for which we have the longest data for over 200 years. But you can see that also in Australia and Canada and other countries as well. And more recently, as countries have joined the international trading system. So starting to see signs of it in China. I suppose probably the most famous example post-Second World War was Japan. It was kind of on its knees in the late 40s and then became the miracle economy of post-Second World War reconstruction and has started exhibiting exactly these 18-year economic cycles of boom and bust. Now, these cycles are structured in roughly 4 or 2 phases, depending on how you count them, but essentially 14 years of pretty much expansion and 4 years of crash and things looking pretty difficult and a slow recovery process. And you could then divide the 14 years of expansion into roughly 2 7-year halves, interrupted by a mid-cycle recession, as indicated in that. Now, the 2 halves of the expansion are different. So the first half is usually characterized by relatively slow growth, but more importantly, investors are quite fearful because we've just been through the crash of the previous cycle and we're looking backwards, and every time there's a bad piece of news, we're wondering if the return of the bad times are upon us. Whereas in the second half of the cycle, we've been through a mid-cycle recession. These tend to be much less severe in impact than the end of cycle recession. And there's actually that sort of process gives us a bit more confidence that actually, maybe for the first time in history, our political masters have solved the boom bust cycle and people are a lot more bullish and things go much more over the top. And they tend to be the best years for investors in property and stocks and commodities and other things. And in particular, when things are going over the top, the final 2 years into the peak, as indicated in the slide, the winner's curse phase is when you really see sort of outrageous behavior and silly things going on. And it's a clear sign that things are heating up and going over the top. But it is a 2-year period and things can be unreasonable and irrational and crazy for much longer than people typically think. And so they tend to be sort of fairly uncomfortable if you're thinking that things should be crashing down. So that in essence is the overall 18-year cycle. Now, it's not exactly 18 years every time. Some cycles tend to be slightly longer than others, but there's surprisingly little variation around it if you go back over the history. And one of the things that is so good about Phil's book is that he takes the entire span of US history from effectively from independence to the present, and writes that economic history through the lens of these 18-year cycles. And you can see the repeat, even though, in 1800, the US was, let's face it, a rather backward agricultural economy to the superpower that it is today, highly advanced, very technologically sophisticated. And despite all of those changes, despite the fact that mostly for the 19th century, we were on a gold standard, for example, so that limited how much money could be created to the sort of fiat currency system that we have today, despite the fact that in some phases we had very high inflation, in other areas we had very low inflation, very high interest rates, very low interest rates. In some areas we were fighting wars with various countries, in others we weren't. The cycle has endured nonetheless. And the reason for this is it is fundamentally based upon speculation in real estate, which is why we sometimes refer to it as real estate cycle, but it is fundamentally the economic cycle, which kind of modulates the periods of boom and bust in our economy, and therefore affects how the stock market does, how the real estate market does, how when businesses have good times and when businesses have bad times. Can I go to the next slide, please, Darren? I said it's most obviously seen in the real estate market. So this for post Second World War property prices in the UK and from the mid 70s in the US shows that. So we had a run up in property prices that were fairly steady until about the late 60s, early 70s, and a sort of massive boom. And this is property prices in real terms. So in nominal terms, the boom in the early 70s was even greater, to a peak in 1873. Then things came down. We had a dip, actually a rather significant dip in property prices in the early 80s to do with a mid-cycle recession, and then we had a major boom into 1989 in the UK, and then things came crashing down. There's a lot of people probably bought property in the late 80s. I know my parents did, and then had several years of negative equity in the early 90s. But of course, things do eventually recover, and they recovered very strongly into the peak in 2007. And then we had the global financial crisis in 2008 and 2009. And the reason why real estate is so important is that, fundamentally, we all need real estate to live, to work. Everything that we do in the world has to take place somewhere. And it's a finite resource. It's probably the most finite resource because there's only so much land in the best locations where we all congregate to live and work. And therefore, it's the most amenable to speculation and things running up over the top. And because we all have to use bank lending to acquire real estate, the banking system is linked to the property market. And when things go over the top and then come crashing down again, as they must, because the economy can only take real estate prices of a certain level, then that brings down the banking system. And that's when you get things like businesses losing access to credit, which is so important to their ongoing sustainability. And therefore you then get the periods of difficulty that my father's business had in the early 2010s, because it effectively couldn't access bank credit and therefore couldn't pay suppliers and had to lay people off and all that kind of stuff. So this is why we get a economic cycle related very much to what's going on in the real estate market. But it's not just about the real estate market. So if we move to the next slide, it's also about the stock market, and the stock market does also indeed ride up the periods of boom and bust in the overall economic real estate cycle. And so on this chart, what I've done is I've basically taken US stock market data from 1800 and chopped it up into roughly 18-year segments, and then sort of average it out, because obviously you're talking about, the Dow Jones in 1896 was at about 30, and it's now, close to 30,000. So you had to sort of find a way of averaging it out. And what you find when you do that is you get a pattern which is suspiciously like the kind of rather crude illustration that I just showed you. And the reason for that, of course, is because the stock market does also ride up the real estate cycle. So what you have is you have a slow start on the left-hand side when, there's still a lot of economic turbulence to do with the aftermath of the previous cycle crisis point. And then things recover and then they accelerate into a mid-cycle slowdown. And in this graphic, it sort of shows sideways prices for a period of time. Of course, in any given cycle, the behavior might be different. So in the early 80s mid-cycle recession, the stock market did go sideways for about 3 or 4 years. And quite famously, I think it was Business Week magazine in 1982 proclaimed, asked the question, is this the death of equities? Because, the stock market hadn't gone anywhere since the mid 70s. That contrast that with what happened in 2001, the mid-cycle recession of the previous cycle, where actually prices came down about 50% and then had a pretty significant bounce off that. And so it was a shorter and sharper period, lasting about a couple of years. Anyway, the mid-cycle recession leads into the stronger second half of the cycle. As indicated, things go even higher. It doesn't, what we find looking back in history is that each cycle tends to be bigger than the last, and that's reflected in stock prices as well, though not necessarily the stock prices of every single country that's experiencing the cycle. That, to a certain extent, depends on some local factors and what's going on in the politics and policies of that country. But nevertheless, in general, it's a truism to say that each cycle is bigger than the last. And that leads into the peak and then a crash. Now, it might not look like it from that diagram because it averages out, stock prices from over 200 years worth of data. But essentially, in the US, the fall in the stock market at the end of the cycle is on average 50%. And after the Second World War, the evidence that I don't have as complete a picture for other countries as I do for the US. The fall in the stock market is even greater. So most famously, I suppose, Japan in 1990, that came down almost 90%. But also the UK after 2008, came down more than 50%, and similarly in Australia and other countries as well. And so these are major market events for the stock market, clearly linked to the overall 18-year real estate cycle. So even if you're not a property investor, you really do need to understand the dynamics of the real estate cycle, what I've called the economic cycle.